Imagine a trading floor a few decades ago. It's a world of constant noise, where brokers shout raw numbers to track the latest prices. Attempting to trade by staring at these disconnected points is nearly impossible. You see the numbers, but you lack the context and momentum to understand who's actually winning the fight. Traders solve this by translating that chaotic data into the clean, visual structure of a candlestick chart. These shapes function as a real-time ledger of human psychology, recording the specific moments where fear, greed, and indecision drove the price. Mastering this language transforms you from a guesser into a strategic observer, giving you the ability to read the market's psychological footprint before you ever place a trade. A single candlestick's thick center is the body, representing territory captured between opening and closing prices. Color reveals the victor. Green shows buyers pushed the close higher. Red indicates sellers dragged it lower. The thin lines are wicks, marking extreme highs and lows. These wicks represent failed offensives. They show us moments where one side pushed the price to an extreme, only to be overwhelmed and forced back by the opposition before the period ended. A single candlestick provides an immediate snapshot of who won the session and how fiercely the opposing side fought back. When open and close prices are nearly identical, we get the doji. This shape represents a total stalemate, a moment of market indecision where neither side could gain an inch of ground. In a hammer pattern, sellers aggressively drive the price down, but buyers violently surge back to reclaim that lost territory, leaving a long lower wick in their wake. But the shooting star is the opposite, a failed upward rally where buyers hit an invisible ceiling and get slammed back down by sellers before the close. Recognizing these profiles allows you to spot early warning signs that the prevailing momentum is running out of steam. However, context is the rule. A reversal pattern means nothing in a choppy, sideways market. We must look for support and resistance zones, historical floors and ceilings where the market repeatedly reversed. A shooting star becomes a high-quality signal when forming precisely at a historical resistance ceiling. It confirms sellers are actively defending that level. The predictive power of any candlestick pattern depends entirely on its interaction with the larger architecture of the chart. Even the most perfect setups can fail. The market has no obligation to follow a pattern, and even veteran traders expect frequent losses. A candlestick chart's primary value lies in its ability to provide a mathematical framework for strictly defining your capital exposure. The extreme tip of a reversal wick serves as your invalidation point. Breaking below a bullish hammer proves your thesis wrong. This creates a logical place for a stop loss. Set just below that wick, it automatically closes the trade if the market moves against you. You then calculate your position size based on the distance to that line, ensuring you only risk a small, predefined percentage of your account on any single trade. Reading candlesticks correctly moves you away from guessing market directions and toward a system of executing high-probability setups with defined, contained risk. To practice without financial risk, open a free FXNX demo account and identify live patterns today.